Today we're going to talk a bit more in depth about stop hunts. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Last couple of weeks we've had a lot of volatility in some of the euro pairs and in a lot of the pound crosses. We've talked about the 12 candle rule, the market maker template, stop hunting, the time of day, the importance of the ranges of movement outside of the Asia consolidation. And today I've had a lot of emails in the last couple of weeks, just a lot of great questions, a lot of fantastic feedback. One thing I'm going to encourage all of you to do, and we talk about this in the 7-step daily routine for high performance traders. If you haven't done so, go to my blog, download it. It's an audio file. Set up your own daily routine. The purpose of that daily routine is to develop the best practices that are going to help you to keep developing your skill set in moving forward in the direction of constant progress. A lot of times retail traders, myself included, will regurgitate the same stuff and maybe in a different way, shape, or form and hope to get a different result, but really nothing's actually really changing. And as I've talked about in a lot of my videos, for me it was about removing a lot of stuff out and actually looking at what was I capable of doing in terms of my schedule, what I was looking for in terms of the style of trading, what was I comfortable with in terms of risk and time frames, and what was I looking for as a reasonable expectation of what I could produce. And so you have to cultivate that around your own schedule. You can't just say, I want to make 100 pips a week. What does that actually mean when you break it down into a day-to-day practical application that you can duplicate, like a cookie cutter approach based on your availability at the screen, especially if you're working around a full-time job? What's reasonable in terms of what the market will offer you in terms of its range of movements, the risk reward, the spreads, all these little things. And we're going to answer a couple of questions a little bit later in the video about some of the things I've been asked about some of the trades. But today we're going to go a little bit more in depth just about, again, specifically talking about the stop hunt coming out of the Asia range. Now, we've talked about the consolidation, stop hunt, trend, pullback, and consolidation, which is a normal trading day, just a normal trading day. Obviously, there's going to be different types of days, but that's a normal trading. And again, that could be in the opposite direction: stop hunt, trend, pullback, and consolidation. That consolidation into the pullback is where we get the Asia consolidation. Normally, I like to see a range of 25 to 50 pips. Obviously, there are other types of ranges that develop in Asia where the box blows out. We're going to go into more depth in the different variations of that later, but for the most part, we're looking at just a fairly tight consolidation. If the box does blow out, redraw the box at the most recent initial high of the day and initial low of the day as you head into that last 1/3 of Asia into the London Open, the Europe London Open. Now you'll notice I have LOW, HOW. That's the high of the week, so the previous week's high, and the low of the week. These are critical areas, especially as we head into a trading day, if you're at the high of the day or the low of the day and they coincide with that area. We talk about 3 things that markets do. Number 1, they break out, they fill more orders, and then they trend. They continue. And we call that a trend trade. Okay? Whether it's up or down. Number 2, they break out, they pull back, and they reverse. And we tend to call those false breaks. Or as Colin Nicholson would say, they're marginal new highs and marginal new lows because they actually are breaks, but they're false breaks and they reverse. Okay? Number 3, they break out, they pull back, and they go into a trading range. That's all that markets do. Those are the only 3 things that markets do. So if you think about that as we head into the Asia close and we have a consolidation, one of the things that I look for, one of my primary premises is to not trade. I want to not trade as much as I can. I want to trade as little as possible and focus on the highest possibility trading setups. So one of the things that I wait for is for the market to actually break out of that box. if you can understand one concept from today's video, it's all about how the market trades around the low of the day and the high of the day. How it handles itself when it gets to those extremes can tell you a lot about the market and what's going to set up. So once I get these 3 big strong pushes outside of the box, whether it's up or down, it could be 3 candles, it could be 2 and a small one and then 2 more and then a big one. The market will try and trick you, but essentially it's going to come in 3 pushes either way. And we talked about this in the last video. That tends to obviously stop hunt potentially profitable trades from the previous session. So your peak formation, bull shorts from the previous session, or long trades from the previous session if it's a stop hunt short. It also triggers breakout traders. So it entices new orders into the market that are pending orders sitting above or below the market. And it also triggers technicals for other system traders and traders who may be using robots or just discretionary breakout trades. I like to see that range be at least 25 to 50 pips. It's not always like that. Occasionally we will see the market stay consolidated and do 3 pushes into a high or 3 pushes into a low and still stay fairly tight around the initial high or low of the day. But again, this will come with screen time, and it will also come with you printing off your charts and going back and studying the different variations of how these playbook setups will present. But one of the main types of simple setups that I like to see are 3 big pushes or a fairly strong push that occurs out of the market, 25 to 50 pips outside of the market, and eventually ends in a pin bar or a hammer. So the purpose of that is that obviously at 25 to 50 pips, it usually will have hit most existing retail orders above and below. But also when you study these enough, you'll see that they will usually present with a pin bar or a hammer type bar after that range of movement, which means it's usually exhausted itself and it's triggered more orders coming back the other way, whether it's above and selling. So they've triggered a lot of pending orders and breakouts and stops as well, and then pulled back, and they've cleared all the orders out on both sides and then pulled back. But this is a fantastic setup once you see the stop hunt occur outside of the box, especially if it occurs at a previous low or high of the day. At that point, you can then take, once the market's cleared that out, if it is to reverse, the first place it's going to go is to the other side of the market in most cases. So now you have the opportunity to potentially assess an asymmetrical risk reward. If this is 15 to 20 pips, that range may be 50 to 60 pips away, so you're looking at maybe 4 or 5 to 1. If this is a trending market coming into this, that may be a 10 to 1 opportunity. Again, this is where your other technical skills come in terms of assessing where you're at in the overall market structure, but also, especially if it's the low of the week and the market has the potential to go back to the high of the week, or vice versa, you could be looking at the AWR, or the average weekly range, as a potential profit target. So, in some of the pound crosses, it might be 500 pips, so you might be risking 15 to 20 pips to target 400 or 500 pip movement. Now, not to say that you're going to get that every time, but again, just stepping back and letting the market tell you when to trade. Are there trades, momentum trades coming out of the box? Absolutely. But as we talked about in last day's videos, one of the things that I like to try and establish is that if I have the opportunity to position myself potentially at the high of the session or the low of the session, and potentially the low of the day or the high of the day, because the market has done all of its work down here or up here in terms of triggering all the orders and taking all the money off the table, it will then target the other side, and the likelihood of it returning there is almost very minimal, because if it goes back, it allows losing traders to then get out of their position or get out of break even. And that's something that you really need to sort of get your mind around, because that's what the market's about. It's about following where the money is. So again, the markets will do 3 things. They break out, they fill more orders, and they continue. They break out, they pull back, and they reverse, and and they'll go to the other side of the range. We call that a false break. And they break out, they pull back, and they'll go into a trading range. So again, if this is a breakout and it's a false break or it's going to reverse, the other side of the range is the first place that it will target. Because again, that's where most stop losses have been placed, or pending breakout orders above and below. And again, if you can correlate that with your previous high of the day or low of the day, and then the high of the week and the low of the week, that's when you can target asymmetrical risk-reward opportunities. So hopefully that helps fill in some of the questions that I have been asked. One of the other questions was, do I hold on to these positions overnight? Very rarely will I do that. Monday, Tuesday, we talk about 80% of the time that is potentially a high or a low of the week. Sometimes Wednesday. If I am in a level 1 trade where I think I've come off of a peak formation low or high, and I have the opportunity to maybe participate in a low of the week, high of the week trading range, yes, I will hold on to those trades. For the most part, I do not hold on to those trades. I take a specific profit target and I'm out prior to the market rolling over into the next session. If you take a look at the first hour of the day, there's a lot of things that happen when the market consolidates and rolls over. The spreads widen. There'll be anything from 40 to 80 pip spikes in that first 10 minutes where market makers, brokers, whatever, they basically spike that and they run all the orders. They flush the board. So it's almost free money for them. And there's been some questions asked. There was some market maker videos put up last week where they interviewed some market makers and they basically rubbished all of that they don't have orders. Go back and watch Anton Kreil's video on how the markets work and where the liquidity actually comes from. 90% of the liquidity comes from banks. And the entire industry from the top down is pretty much run from that liquidity and the narrative that it wants promoted to the retail public. So if you want more information on that, again, I'll include that video link below for Anton Kreil. But go back, draw your lines, study your charts, print it off, identify 2 or 3 really simple basic setups that you can relate to. Focus on those. Don't try to trade the same market every single day. Try to focus on the setups, and when you find them on certain pairs, target those, trade them better, get better at those, trade them bigger, and may the markets go with you. Have a great trading week.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.